Good afternoon. Thank you for joining us once again. So we kick off the results season today, and we are happy to bring another set of good results for quarter three. I am going to take you through some of the headlines, and then we will throw it open for questioning. So I think the headline is that quarter three we had a very healthy bottom line, a PAT growth of 30% year on year and 4% quarter on quarter. And this has been fueled by very strong revenue growth. And one of the revenue drivers, which is the net interest income, actually rose by 36% year on year and 7% quarter on quarter. So I think the takeaway is that the quarter on quarter growth is also showing pretty robust increases. And the NII growth of 36% has been supported both by the corporate bank and the retail bank. And you would notice in the details that for the first time in several quarters now, retail growth outstripped the corporate growth. Retail growth came in at around 29-30%, and corporate growth came in around 27 odd percent. Along with this, the core fee income has also grown by almost 30%, and we have kept our ambition of core fee growth exceeding loan growth for the 31st consecutive quarter. Very good traction on CASA as well, and the star performer, as in previous quarters, is the SA part of our balance sheet, which has again grown by a good 32%. In addition to this, the book quality has remained stable. None of the events that we have heard about being talked in the markets seem to have moved the needle for us. We have come up with a total credit cost of 17 basis points as against 15 basis points in the previous quarter. And the three-quarter credit cost is now 43 basis points. So we look like we are going to be within our stated objective of 60 basis points for the credit costs. Very small movements in gross and net NPAs. Net NPAs moved up by 2 basis points only. Apart from this, the drivers for, say, net interest income, of course, are the retail part of our business and the corporate, as I said. The retail part, the vehicle finance business, the trending is now becoming very, very evident. And we saw very healthy growths in both the MHCV section and certain other parts like auto. And two-wheelers, of course, started showing growth as well. In the last 2 quarters, we've seen some growth. So there was a positive growth in the two-wheeler section as well. And accompanying this robust growth on the vehicle finance sector is also reduction in our credit costs on the vehicle finance sector. Then in consumer, the non-vehicle retail that we've talked about, we've been talking about for several quarters now, also showed very robust growth. Non-vehicle retail now accounts for almost 10% of our total loan book, and that also comes with a good yield. So the rebalancing of the book that we've been talking about, if you were to exclude the diamond business that we acquired in July, then I think the rebalancing has happened. We were 60-40 in favor of corporate, 60. We are now 56-44. So that rebalancing is happening. And we believe that that has a very beneficial impact on both yields and net interest margins. So as far as the major vectors are concerned, NIM was stable. It moved up by actually 3 basis points. Return on assets has remained stable at 1.92%. Return on equity, of course, fell because the full impact of capital came in. So the capital averages out much higher level. So you know that in July we raised 6,000 crores. So the full impact of capital has come in. So the vectors that we measure, whether it is NIM or ROA or ROE, have moved along nicely. In addition to this, we recommenced the momentum on our branch opening. So we have opened about 51 branches during this quarter. That takes our total branch network to 905, and we are on our way to achieving the total objective of 1,000 branches by the end of this fiscal year. So I think that's a summary of what has happened. The top lines have moved nicely in strong double digits year on year, and also high single digits quarter on quarter, and bottom line has also happened. So I think we have navigated the asset quality issues pretty decently, because the needle moved by just 2 basis points on our net NPAs. So I think it's a quick summary. We also have 9 months results, so the press release is with you. So we give you the quarter results. We also give you the 9 months results, and the 9 months results are showing a very healthy trend. Again, strong double-digit growth in every vector that you would want to see. So that's a quick summary of the headlines. The other one, of course, is the capital adequacy ratio. Capital adequacy ratio probably is amongst the highest in the industry now. So our CRAR was at 16.43%, and in quarter 3, I think it was about 8 basis points more than this. So capital conservation, while we are achieving growth and maintaining the book quality, while we are growing at 29%, I think that these are the two big headlines that we would like to talk about. So that's it in terms of headlines. I think the press release tells you all, and we are more than happy to answer questions.
Afternoon, sir. I'm Neha Bothra from ET Now. I wanted to ask you, what is the value of assets you have sold to ARCs in the third quarter?
Yes. So we had a net increase in our SR book, which is the security receipt book, of 31 crores. So we sold 53 crores and we recovered 22 crores. So the net increase is just 31 crores. So actually our, not only the ARC, the restructured book also has remained stable. Actually it has moved down from, I think, 63 basis points to 59 basis points. So I think overall these vectors look pretty decent.
Also, could you add some color on the kind of slippages you've seen in the third quarter?
So the slippage ratio, which was, say, 1.29% in quarter 3 of last year, has fallen to 1.07% in quarter 3 of this year.
So,
I think there's somebody raised a hand before you.
so you mentioned about the SME auto loans, which is gaining traction. You said that they've quite a robust growth. I want some more color on how it has grown and
Yes,
you know,
yes.
where are we now exactly.
Certainly. Pata, would you like to take that question? We can even show you, maybe we can put up the slide, and then while Pata can talk about it.
Yeah.
The slide gives you the numbers that you may be looking for.
Yeah. See, basically, most of the automobile industry has shown growth. Commercial vehicle leads the way. The market growth is about close to about 30% over the previous year, whereas we had grown over 50% over the previous year. I mean, we are higher than the market in most of the places, most of the vectors, except for two-wheelers, where the market has remained more or less stagnant and we are slightly low, which we are catching up in the last quarter. The industry appears, the commercial vehicle industry appears to have gained momentum. The last, the volume is about 207,000 vehicles for the current year so far, and it is likely to the end of the year with close to about 270 to 280,000 vehicles, which is closer to 320,000, which is the peak. Therefore, if the current trend, if it is any indication, next year should be the peak for the current and for the commercial vehicle. And since we are growing more than the market, we are expected to do reasonably well in the last fourth quarter and the quarters coming ahead.
So what does it tell about the macro situation? The worst days are behind commercial vehicles. Can we say that first of all? And secondly, what does it mean for the macro in the sense mining, coal, power?
Yeah, today, whatever the industry has experienced is without the mining sector inputs. Mining sector has not grown all that very greatly. Now it is more on a replacement market, and the pent-up demand created by slowness of the industry for clearly nearly 2 years. The real growth should happen sometime during the last quarter, which is January to March, and also the next year. And one of the major indication of macro things moving much better is freight rates being stable, input costs are coming down, and the third thing is the portfolio has improved, shown consistent improvement not only in the NPS front but also in various other buckets. Therefore, these are definite indications that the market is improving.
I believe you already use a hybrid method for calculating your base rates, but now when you move to only marginal cost of funding, what kind of impact will that have? And what percentage of your book is fixed? Could you also clarify?
Yeah, so the second part of the question is about 70% of the book is fixed rate. And the new dispensation described by RBI, I think it's a progressive situation. RBI has now allowed tenor-wise, MCLRs, which means that some sort of a yield curve will emerge from overnight to whatever 6 months or whatever. And as far as impact goes, secondly, it's forward-looking, so it is prospective, right? It doesn't have retrospective effect. I think that's the biggest relief as far as banks are concerned. Now we have done our own internal calculations, and we see that the impact of this is very, very marginal for us. So we were already in a way on the sort of marginal cost of funding, and internally, of course, we are now developing the MCLRs for the different tenors, because now they allow tenors. Overall, I think probably this new methodology will create more sensitivity to policy rates. So repo rates will get, I think, transmitted more quickly than that thing. But I think the impact, because of our fixed rate book, which is not linked to BPLR, I think the impact is very, very marginal on us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.